As you enter your 20s and 30s, it is important to start thinking about your financial future. Unfortunately, many people make the same money mistakes that can have long-lasting effects on their finances. From not budgeting properly to relying too much on credit cards, these mistakes can have a large impact on your financial health in the future. In this video, we'll be discussing the biggest money mistakes that people in their 20s and 30s make and how to avoid them. By the end of this video, you'll have a better understanding of how to make smart financial decisions and avoid common pitfalls. So let's dive in. Mistake number 1, not creating a budget. A lot of 20s and 30s view budgeting as just having enough money to make ends meet. They think as long as they don't overdraw their account, they can go out and have a good time, and pay their rent on time, they're good. But as they grow older, they'll realize that money needs to work hard for them, not just be spent on happy hour. That's why it's important to ask yourself, where is your hard-earned money going? And more importantly, how are you planning for the future? If you can't answer those questions, it's time for a reality check. Creating a budget can help you track your needs and wants and highlight those non-essential purchases you make every day. Start tracking how money is spent on bills, debts, and savings in order to plan for the future rather than just living in the present. To avoid this mistake, make a budget by analyzing your income and expenses. Your income should exceed expenses, including debt repayment, savings contributions, and future investment. If it doesn't, adjust your budget by cutting non-essentials. Mistake number 2, not saving for emergencies. Many young people struggle to start saving because the future seems far off, but let me tell you, the benefits of compound interest are real. If you don't know, compound interest is interest earned on interest and it helps money grow, but only after several years. That's why setting money aside in an emergency fund is crucial. Not only will it reap the benefits of compound interest, but it will also create a safety net for unexpected expenses. You know, like unemployment, medical bills, car repairs, home repairs, and even taxes. Trust me, these unexpected costs are inevitable, so it's best to prepare for them and avoid a higher cost alternative like using credit or taking out a loan. To avoid this mistake, set aside enough money to cover 3 to 6 months' worth of expenses in an emergency fund. It doesn't have to be a lot, just start with a small amount and gradually strengthen your safety net. It's never too early to start saving, so don't wait any longer. Mistake number 3, not paying off credit card debt. Maxing out credit cards is a common mistake among young people, and it can have serious consequences. Credit card companies love to target young people with offers of low fees and introductory rates, but it's important to remember the financial responsibility that comes with using credit. High balances and minimum payments can hurt your credit score and take years to fix. Many people make the mistake of not paying off their credit card debt, which can lead to high interest rates and long repayment terms. To avoid falling into this trap, stick to the golden rule of only using credit if you can pay it off in full each month. If you're already struggling with credit card debt, it's time to make a plan to pay it off ASAP. Don't let credit card debt hold you back from reaching your financial goals. Mistake number 4, not taking advantage of employer benefits. Are you not thinking about retirement yet in your 20s or 30s? Well, listen up because this mistake could cost you big time in the long run. Not putting money into a 401k or IRA is a huge missed opportunity, especially when you consider the power of compound interest. Starting to save early means your money will have more time to grow, and by the time you reach retirement age, you'll be sitting on a much larger nest egg. But that's not all. Many companies offer matching contributions to retirement funds, meaning they'll match the amount you put in up to a certain percentage. That's free money. Can you imagine having tens or even hundreds of thousands of extra dollars just by taking advantage of this perk? So, how do you avoid this mistake? Financial experts recommend contributing at least 15% of your income into a retirement fund, and if your employer offers a matching contribution, make sure to take full advantage of it. Mistake number 5, not having proper insurance coverage. Don't think you're invincible just because you're young. Time to think again. As a 20-something, it's important to understand the importance of insurance. Whether it's protecting yourself from a medical emergency or property damage, insurance is a must-have. Insurance is a program that allows you to protect yourself from the worst-case scenario. By paying a small monthly contribution, you're pooling your money with others. If something happens to you, the pool covers your expenses. The key is to get insurance before you need it. You don't want to be in a situation where you have to drain your savings or rely on high-interest credit to cover expenses. So, don't wait. Establish your insurance policies. If an emergency occurs, pay a small monthly fee rather than a large bill. Make sure you're covered on all fronts: health, dental, vision, renters or homeowners, disability, life, and anything else that applies. Mistake number 6, not having a plan for student loan debt. Ignoring your student loans is a surefire way to tank your credit score. Late payments on student loans can have a major negative impact on your credit report, and that means a lower credit score. And trust me, you don't want that when it comes to getting the best interest rates in the future. But don't worry, there's an easy way to avoid this. Stay organized, know the total cost of each loan, the monthly repayment amount, when it's due, and how to submit payment. And if you're struggling to make payments, don't stress. Most federal student loans are included in the federal student loan forbearance. And there are other options like alternative repayment plans, consolidation, refinancing, or deferment that you can explore with the government or private lenders. So, the bottom line is this: before you even leave school, create a plan of action for repaying your student loans. Know when your grace period is, make at least the minimum payments, and if you can, make extra payments as your budget allows. It's worth it to stay on top of your student loan debt, rather than letting it snowball into a bigger problem. Mistake number 7, not being mindful of your spending habits. Are you guilty of overspending on luxury items like clothes, vacations, and electronics? It's easy to get caught up in the moment, but overspending can lead to debt and financial trouble down the road. The key to avoiding debt is to live within your means. That means only spending what you earn and not relying on high-interest options to cover the cost of non-essential items. Here's what you can do to avoid falling into this trap. Compare prices before making a purchase, borrow items instead of buying them, and limit new purchases and be mindful of your spending habits. It's important to learn to be grateful for what you have and not use expensive purchases as a way to fill a void. By being mindful of your spending habits, you can avoid falling into debt and take control of your finances. Mistake number 8, buying a brand new car. If you're thinking about buying a brand new car, think again. As a 20-something, it might be tempting to buy the newest, shiniest model on the market, but it's important to remember that this is a big financial decision. You might end up sacrificing other important things like debt payments or savings to finance a brand new car. But here's the thing, a brand new car is not always the best option. A used car that's cheap, reliable and functional can be just as good. So, before you make a decision, do your research and shop around. Check out car dealerships, online car buying sites, and even word-of-mouth car sales. You'll be surprised at the great deals you can find. And remember, a car is a means of transportation, it doesn't define who you are. So don't be tempted to overspend on something that's not really worth it in the long run. Mistake number 9, not negotiating salary and benefits. This is a big one, and it's something that a lot of people don't think about when they're starting a new job. But the truth is, if you don't negotiate your salary and benefits, you could be leaving a lot of money on the table. The key is to do your research and know what the market rate is for your position and experience level. Then, when you're negotiating, be confident and be prepared to explain why you deserve more. And don't forget to negotiate benefits too, like health insurance, 401k matching, and vacation time. Mistake number 10, not saving for a down payment on a house. This is another mistake that can have long-term consequences. Buying a house is a huge financial commitment, and if you don't have a down payment saved up, you could end up paying more in the long run. The good news is that it's never too early to start saving for a down payment. Even if you're not ready to buy a house right now, start setting aside a little bit of money each month, so that when you are ready, you'll have a nice chunk of cash saved up. And don't forget that, There are also the down payment assistance programs and other options to help you save for a down payment. In conclusion, these are the biggest money mistakes to avoid in your 20s and 30s. By avoiding these mistakes, you'll be well on your way to building your wealth and achieving your financial goals. It's never too early or too late to start making smart financial decisions. Thank you for watching, and don't forget to like and subscribe for more videos on how to make the most out of your money.